Hi, everybody, and welcome to our new show. Hopefully, I look vaguely familiar to some of you. My name is Susan Warnick, and for years was the consumer reporter on WCVB Channel 5 here in the greater Boston area. And as you would know from my years on television, I have been desperate to help you save your money, invest your money the right ways, and frankly, just not lose the money. So we decided that we're going to start this new show for all of you to help you do exactly that, protect your money. And we are calling our show Money Talks. And I've got two of the best guys who talk about money with me. They are from Finer Management Consultants. Michael Finer, Finer Management, Finer. You didn't change your name just because it was a good idea, right? That was always your name.
It's a good name.
Mike Finer. And Gary Kuhn, also from Finer Management. And this is going to be great that we have an opportunity here to actually help people who I think oftentimes are really confused about how to invest their money. Especially recently. Michael, I'm going to start with you. The stock market. Every day you hear something different about the stock market. So what do people need to really know about investing in the stock market?
That's a very good point, Susan, because the stock market actually has reached all-time highs at this point. Historically, both the Standard & Poor's 500 and the Dow Jones Industrial Average. But I think what people have to recognize is that the stock market is really a function of all the companies that make up the stock market. So there are thousands of U.S. companies right now who are earning incredible amounts of good profits and are making excellent products and are exporting their goods to other countries and into the United States. And because of the record profits and because of the productivity and new technology, that the stock market has reached new highs.
But it's so volatile. And I think that scares people because they don't understand it, number one, and number two, because they can't control it. So Gary, what do you say to people about that?
Well, one of the things you look at when you invest is some diversity, diversification to help deal with that volatility. We can also look at certain companies actually are scored based on their volatility. So if people have concerns about that, you can actually address that in a portfolio by looking for those positions that have a lower volatility on average.
What do you mean they're scored? They're like 1 to 10, or how does that
there's
work?
Certain stocks that have, they call it a beta, and stocks are ranked compared to the overall market and how they perform in terms of when the market goes up and when the market goes down. And some stocks tend to show over time lower volatility, so you can actually build a portfolio that takes that into account.
So somebody who's nervous about investing in the stock market could look at a stock at their beta score, and that helps determine whether or not they're in for a roller coaster ride? Is that how that works?
Exactly. If you think of stocks, high technology stock, in the old days like AOL or Google, they tend to have a beta score that's very high because when the stock market is very strong, the stock tends to go up. And when the stock market is weak, it tends to go down, but goes down much more than the market. If you get a stock such as Clorox or Campbell Soup, as you might suspect, when the stock market goes up, it might go up a lot less, but when it goes down a lot less. So certain stocks have just much lower volatility and lower beta than other stocks. So you can design a portfolio to reflect someone's risk profile or their sort of behavioral needs, if you will, over time.
Well, you guys know
and
me.
remove it.
I'm
the
not
other thing I might
thrill
add,
seeker, so that works for me.
Susan, the other thing I might add with respect to that volatility, I think sometimes if you can build a portfolio that pays good dividends, the stocks pay good dividends, you're paid to own that particular position. So over time, you're going to earn those dividends. The stock itself, the value of the stock might fluctuate, but you're getting paid over time. So I think that helps people deal with the short-term volatility because they know they're going to earn money by owning that stock because of the dividends.
Right, you just mentioned short-term, and I know I've heard you guys say this before, and I mentioned roller coaster ride. The stock market is not a short-term activity generally. Is it the sort of thing that you want to just get in and out fast, or do you want to just sort of get in it for the long haul?
Well, the long haul tends to be the better approach because over the long haul, the stock market tends to have good positive returns over the last several hundred years. The short term, it's anyone's guess sometimes because, like any market, it's subject to the latest news flash. It's subject to earnings of companies. It's subject to political risks. It's subject to just people's moods. There's actually studies that say that on full moons, the market isn't necessarily, it's more volatile than not on full moons. So the short term can be volatile, any 1 to 3 year period, but generally any 10-year or plus period has been positive for markets over the long term. So for someone who has a long-term horizon, and I'll call that at least 10 years, the market generally does not go down, assuming that you own a diversified portfolio with good, solid performing stocks and not betting the ranch on any particular 1 or 2 investments, which is also a recipe for disaster.
So Gary, who should get into the stock market? Who's the ideal investor?
I think people who do have at least a certain time horizon that's looking to expand their wealth over time. Again, you need to take into account your needs in terms of if you need those funds on a short-term basis. That would be something that you might not want to put all your money in the stock market. But if you have a longer-term time horizon, whether you're a young person, starting to save over time for college, that's something that parents consider. People do live longer today based on the technology that we see. So if someone, 40, 50 years ago, someone, at a certain age might not feel that they have as many years left. Now that same person might have 30, 40 years after retirement that they have in terms of time horizon, and you're certainly not getting much interest in the bank.
Right.
And although we do have fairly low inflation, that principal that you have is diminishing if it's just sitting there in the bank. So people do realize that with rising healthcare costs and needs that they're going to have over time, that the stock market is one area where you have an opportunity to earn a greater gain.
Anything to add to that, Mike?
People who need to get a rate of return, in excess of 3 or 4%, which is most of the population, generally should think about being in the stock market because the companies that are in the stock market that make up the indexes tend to produce profits of 7 or 8% per year on average if you take the whole population. And with that 7 or 8% growth means that the entire stock market will tend to rise over time versus the low interest rate environment of historically low interest rates. Right now we sort of have the perfect storm in a good way for the stock market because interest rates are incredibly low, the lowest they've been in several generations. Inflation is incredibly low, which it hasn't been this low for several generations. And the energy costs are the new issue in the economy. All of a sudden, for the first time in probably 2 generations since the 70s, America is energy independent. And as you know, at the gas pump or your heating bill, energy costs are declining precipitously. And that's going to be a setup that is generally good for the companies that make up the stock market.
If you're a business that's manufacturing a product that relies on energy, or you transport products, having the lower energy
You're feeling
costs.
pretty good about life.
Yeah, and the consumer now is paying, less than $3 a gallon for gas versus over $4 a gallon. So that'll eventually have a positive impact, hopefully, on the economy for 2015.
Well, there are a few of us who remember paying a lot less than that for a gallon of gasoline. Folks, I want to remind you that you are watching Money Talks. It's sort of a new show that we've started, and my guests today are from Feiner Wealth Management, Michael Feiner and Gary Kuhn. And we are soliciting your questions, actually. You'll see a address on your screen where you can send any questions that you have, and on future shows, Gary and Michael have agreed that they would be delighted to address some of your specific concerns. So let's move along. We've talked about, and you've given great advice, I think, frankly, and information about the stock market. But let's move along, because here we are looking at the end of the year, and I know there are a lot of people thinking about tax returns, thinking, what in the world am I going to do? I only have a few weeks left. So, Mike, let's start with you. Some advice for people?
Sure. I think one of the biggest things that people can start to think about will be to look at the capital gains and losses that they have had in the stock market since we started with that. Because the markets are up this year, people have had gains in their positions, whether it's mutual funds or individual stocks or whatnot. So at this point, they take a look at harvesting any losses that they could have somewhere else in their portfolio and equalizing any gains that they could have, because there's nothing worse than paying tax on some of the capital gains that you have while you're sitting with some losses in your portfolio, because most portfolios have a combination of gains and losses at any given time. So trying to neutralize any gains, this is a perfect time to think about that. It's also a great time to think about charitable donations. So with Thanksgiving and Christmas coming, take some of those old clothes to the Salvation Army, make sure you get a receipt,
Right.
which the IRS always appreciates,
Right.
receipt. Make donations and get receipts for those before year end. You can even donate some of the appreciated stock that you have to a charity and avoid a capital gain and get a charitable contribution.
Obviously, we're taping this show before Thanksgiving, and some people may be watching it after Thanksgiving. So the key is not necessarily the Thanksgiving holiday, it's
Right.
the end of the year.
End of the year, exactly.
That's the key. You got to do all this stuff by the end of the year.
Right. There's individuals, if they're over age 70 and a half, they may have required minimum distributions on their IRAs. Those need to be done, particularly after the first round, which you have the year until April 1st, the year after the year that you turn 70 and a half.
It's confusing.
It's a little bit confusing.
It really is confusing.
But then you do need to make sure that thereafter you have those required minimum distributions done by December 31st of that year.
Now, I would just like to take a moment to point out that I have a while before I have to worry about 70 and a half, okay? Even though coincidentally my birthday does happen to be December 31st, this will not be the one, or even close. Just need a little disclaimer there. But anyway, it's a really good point, because I think people, first of all, they're very confused and overwhelmed by a lot of this, because the laws seem to change so frequently about when you're supposed to do certain things. But 70 and a half is now
where you're actually now required to take distributions from your IRA at that point. The other thing we've seen with small businesses, and talking about year-end tax planning, a lot of entrepreneurs either solo, you see a lot more solopreneurs, they call them, if there are opportunities for them to create their own pension plan, essentially, or a retirement plan, where they're able to, there are tax advantages to setting those up. But if they want to do that, in some cases, some of the contributions may not have to be done this year. They need to do it by the time their taxes are filed next year. But if they want to participate and take those deductions for 2014, they need to set those plans up by the end of the year. So we're working with entrepreneurs, and even those that have employees, there are certain plans that need to be set up by the end of the year in order to make contributions for 2014.
As you guys know, I have been working with Rich Rubino and Sam Lang at Rubino and Lang, the guys who always say, rule number 1, don't lose the money. Rule number 2, don't forget rule number 1. And I've been to a number of their seminars, and they always talk about how important it is to take a look at that bigger picture. And that's what I hear you saying too. And now is a perfect time to do it at the end of the year.
Yeah, and their approach is very smart. And the idea of rule number 1, not to lose money, is definitely the most important rule in protecting someone's assets. Yeah, it's a smart approach, and that's exactly what you have to do. And you do that either through their asset protection or your investments, or taking a look at a financial plan. And since year end is coming, it's an excellent time to look at all those issues of asset protection, financial planning, tax planning before December 31st, because it's sort of part of the natural cycle where people think about things as a New Year's resolution.
Yeah. So you were talking about how this is the time to make charitable contributions if you haven't already. And you mentioned it's important, of course, to get a receipt. But have the laws changed since last year about how much you can deduct in terms of charitable giving?
They really haven't changed with respect to how much you can deduct for charitable giving. There have been certain things that haven't been reapproved by Congress, of course.
Like what?
Well, if you are required to take money out of an IRA because you're at the age of 70 at this point. You used to be able to take the money and directly send the money to charity and not be taxed on it. That provision has not been approved by Congress yet. Now, it sort of happens every year that after year end, Congress gets together and approves some things after the fact, but that particular provision still hasn't been approved. They do expect potentially that it will be approved, but who knows? So there are a lot of little complex items for charity that they haven't taken action on. So it's very frustrating because clients do come and ask, hey, I'd like to take money from my IRA and give it to a great charity, and they have an incentive to do that with the tax code, and can I deduct it? And I'll say, well, I think you probably might possibly maybe be able to, but I can't guarantee it.
Maddening.
It's usually, it is maddening, and it's
maddening.
usually a fair, it can be a fair amount of money, so it's frustrating, but
And there are ceilings as to how much is deductible.
there are ceilings. Generally, you can only deduct up to 50% of your income to a public charity, and there are lower limits for other types of charities, and there are restrictions on how much you can give to, for clothing and other sort of goods without getting appraisals and other technical things. I mean, the tax code, of course, is gigantic.
People hear all the time about opportunities to donate cars and boats and other things similar, motorcycles and that kind of thing. And the incentive is always for the tax break. But I think a lot of people are confused about exactly how that works. Would you guys mind explaining that?
Well, I guess, sure. Any piece of property, whether it's a car or a boat or a piece of artwork, basically you get a donation of the fair market value of whatever you're donating. So if you have an old car that you bought for $30,000 in the day, but today it has 150,000 miles and might have the Kelly Blue Book of $3,000 value, that's the value that you can put on your tax return if it's donated to the appropriate charity. Generally, there are a few restrictions, but I won't bore everyone with the pain of that. But so it's based on the fair market value, generally, of
Yeah, not what you think it's worth.
Well,
Other
that's the
people-
problem.
Yeah, it's a
Unless-
huge problem.
it
I
is-
mean, people think they're making a $20,000 contribution, and
Well, that's the thing too. People will always say, "Hey, Mike, I'm donating this car, and it's $15,000, so I'll save $15,000 of taxes, right?" I said, "No, it doesn't quite work that way. What happens is that you take $15,000 off of your other income and subtract that. So if you made $50,000 and subtract $15,000, your net taxable income is $35,000, and you get taxed on that. You don't actually save $15,000 of tax, meaning dollar for dollar. So a tax deduction is different than actually saving something dollar for dollar. People always want to donate cars and boats.
right.
So
And sometimes, like I said, it can be very confusing. And
It
the other
is.
thing I just want to take a moment, folks, to remind you is that if you are thinking about doing that, really ask the charity what they are going to use your car or your boat for. Because a lot of places, a lot of times people will donate these items thinking, well, I'm going to be able to give my car to a family that needs a car, when in fact that isn't what happens at all. The charity takes the car, sells it for parts, rips it apart, keeps the change
Right.
under the seat, and your intent isn't necessarily the reality.
Right.
So it's
that's
a really
an excellent point.
good. Thank you. Years of consumer reporting.
That is a
I
good
remember
point.
that. Yeah.
Yeah.
But seriously, it's really important to just ask the charity, what are you going to be doing with this car, boat, or whatever? So what else? What else for the end of the year? What else are there any other changes in the laws that people maybe don't know about, or things that will surprise them when it comes time to file?
I think it's actually been a fairly quiet tax year, believe it or not. Nothing substantial has changed from last year, to this year. But as year end comes, a lot of people are incurring large amounts of medical expenses. So medical costs are out of control. Even if you're in a health plan, they're out of control. So trying to isolate and consolidate medical costs in any given year can be very helpful. We have a lot of clients who not only have health insurance but incur big dental bills. And most dental costs aren't necessarily covered by dental insurance. In fact, you
Are
get
not
dental
covered.
are not.
Yeah, I just
You get
wanna
dental
underscore
insurance.
that.
Yeah, you get dental insurance, and nothing generally seems to ever be covered.
Right.
But you take those dental costs plus your medical insurance costs, and potentially, if you can consolidate those in any given year, there are limits that you have to exceed, and it's often beneficial to consolidate that in 1 year as opposed to spreading it out over 2. So if you may have work or procedures, say in December and January, it might be better for you to do it all in December or January, just so you can get all of the expenses in one particular year to exceed the thresholds to deduct certain expenses. So that can be a nice little technique if you're doing, new teeth, or if you're having, surgery that have a lot of out-of-pocket expenses.
I think we're going to have to do another entire show on medical and health insurance, because if there's anything that's overwhelming and confusing to people, that would be it. But I think you make a really good point, Michael. I don't think a lot of people distinguish between the different kinds of procedures that they have, and dental is huge. How much of the expense is actually deductible?
It generally is over 7.5% of your income. So if your income is $10,000 per year, if you're a senior citizen, the first $750 is not deductible, and the difference is. So it's generally people whose incomes start to decline also tend to have higher medical expenses. And so I would say people, as you tend to get older, tend to be the people who can deduct the cost because incomes are lower and they can exceed 7.5% of the Social Security benefits or other pensions or passive income that they receive while incurring the medical costs. So it's a nice way, and people often overlook it.
Gary, you want to add anything?
Yeah, I think one of the things from an investment standpoint to look at while you're looking over all of your tax issues, your financial planning type issues at the end of the year, if you haven't been rebalancing your portfolio throughout the year, this might be a good time to take a look at that as well, because over the course of the year, the stock part of your portfolio, if you're in fixed income, a little bit in real estate, a little bit in maybe precious metals, if you have a diverse portfolio, there may be certain parts of your portfolio that have now become heavier in terms of that pie chart that you look at. And you also might have certain companies that have gone up quite a bit and may represent a higher share of your overall stock investments than you might want to have. So it's a good time to, while you're going through all of this, to take a look at your portfolio and rebalance it to an allocation that might be more suitable to your particular risk profile. That's something that we do, throughout the year. But an individual investor, this would be a good time to look at that too.
And I'm always reminded of the saying, "Don't try this at home." I mean, some people can do it themselves, no question about it. But we only have about 5 minutes left in the show. And what I really want to touch on is the importance, folks, obviously, of working with a professional. Gary and Michael from Finer Wealth Management aren't going to argue. You need a professional for sure. And that makes a lot of sense. That's what you guys do for a living. But I also just want to point out that there are some very practical reasons why you shouldn't be doing this yourselves. And a big one is that you really, you can be scammed so easily. Let's talk for a minute about why it is a good idea to use a professional to do your taxes, for example. I mean, you guys and other professional tax preparers know of certain deductions that maybe people just wouldn't know of on their own.
Well, like you've alluded to, the tax law is so very complex. I mean, even since I became a CPA almost 30 years ago, the tax code has probably tripled in size just with rules and regulations. So it's really hard for people to understand all of the little nuances of the tax code. We just were talking to a client who, very smart couple, and I think we were able to help them find the fact that they had certain self-employment that they really didn't understand that they could do a separate self-employed pension fund. And it wasn't because they're not really smart people, but it just didn't occur to
who
them.
knows, right? They're not professionals.
Of course,
exactly.
Yeah, but in our business, we have a checklist, and we think about, hey, what are all the things that people can do to limit their tax liability? So I think part of it is just because we're doing hundreds and hundreds of tax returns every year, you tend to get a feel for things that people can do, and because it's so complex, it definitely makes sense.
And the law does change
Yeah.
from year to year.
Yeah, the law changes, and that's even a different issue. Between the law changes and the fact that there are so many things out there that if you don't do this regularly and study it 365 days a year, that you just may miss opportunities that
To save money.
just to save
Yeah.
money. You may do a perfectly thorough job, even use software package that can help you through it, and you still it won't stimulate you for some of the more complex planning opportunities that you may have.
And I want to just take a minute to warn you folks that if you are enticed by one of these services that says, we will give you your refund up front, those usually come with a pretty high price tag. You usually have to pay a pretty good percentage or fee of what your return will be. So help me out here. That's generally not a good idea.
It generally is not a good idea. It's very
How about
costly.
it's never a good idea? I mean, unless it's a relative who says, I'll give you an interest-free loan.
Right.
Right.
Yeah.
So, I mean, it's really important to know who you're dealing with. Make sure it's
Oh,
a
yeah.
certified person. Anybody can hang a shingle, but you need to really
sure.
check.
There are enrolled
credentials.
agents, CPAs, a lot of
Yeah.
other professionals who have expertise that the IRS approves and whatnot. And I definitely would, not even for professionals' benefit, but it probably is worth a little bit extra, especially if your situation is anywhere other than simple, to get a professional
Yeah.
who's an expert.
Yeah, and it's always a good idea to ask friends and relatives who they use, get referrals for sure, and check people out.
Definitely.
And I think remain actively engaged. Just because you're working with a professional doesn't mean you're not still involved. If you have any questions, ask them.
He's talking to me, folks. He is talking to me because it completely overwhelms me, and Gary knows that. But you're right. Don't be intimidated.
Right.
And know that you have deal with people, obviously, who will take your calls and answer them.
Right.
No question about it. Well, you guys have been great. This is terrific. I mean,
thank
people
you.
are, like I said at the beginning of the show, sometimes just don't know where to turn, who to ask, and sometimes you don't even know what to ask. So, folks, if you have any questions at all, we have an address that you can send here, and we're hoping to do this show fairly regularly. We're calling it Money Talks, and as I hope you realize now, so do Mike Feiner and Gary Kuhn from Feiner Wealth Management. We'll look forward to getting your questions, and we'll look forward to answering them for you. And we thank you very much for joining us today. I'm Susan Warnick.